So today's topic is introduction to industry and company analysis. Okay. So first of all, my question to you is what is what is the difference between a company and an industry? And why are we doing the analysis of either a company or an industry? See, being an investor, let's say you want to invest your money, okay, and you are picking this option of stock buying. Okay, you want to buy the shares of a company or stocks of a company, and and you want to become a stock investor. That means you want to become you want to take ownership rights in a company. Okay, so definitely any investor would like to know the type of industry in which he or she is investing and the company which he is picking out of that industry in which he wants to invest. Okay, just a second. So being an investor, you always want to know about the company in which you want to invest, and also you want to know the information about the industry to which this company belongs. So let's take a small example of COVID-19. During COVID-19, hospitality industry, that means hotels and like many people who go for stay to different like tourist places, and if they want to stay in a hotel they cannot do that. Why? Because lockdown, there was lockdown, and people have to quarantine because of the COVID-19 virus. Fine. So hospitality industry was completely into losses. So during those days, if you have not if you would have not done any kind of study and analysis about this particular industry or the companies like Oyo Rooms, SOTC tours and travels, if you are an investor in these kind of hospitality industry companies, then you would have lost lot of money. So thorough analysis is very important. A detailed and careful study is very important before investing into any company. Okay. And also before investing into any industry to which this company belongs. What is the major difference between company and industry? Industry, if I take automobile, if I take automobile industry, and in that too, if I take car manufacturing, you know, there are many company. This is particularly a industry. Automobile has heavy motor vehicle and also light motor vehicle. So light motor vehicle is cars. Okay. Heavy motor vehicles are trucks and buses. So in cars, you have different companies, the likes of Maruti Suzuki, Hyundai, Honda, Volkswagen. There are many companies which are part of this particular industry. So hence, if you want to invest in the stocks of Maruti Suzuki, or you know, very soon Hyundai Motor Company is coming with its own IPO, okay, for which the SEBI has given the approval, a very big IPO they are bringing, 20, I think 25,000 crore they want to raise. So if you want to be if you want to invest in that, then you should have thorough knowledge about Hyundai company's performance and also the industry to which it belongs. Okay. You cannot, you know, like only study about a company's profile and invest. You should also know the potential of that industry to which it belongs, whether it is going to grow and whether it's going to, you know, give, whether you have a bright future in that or not. Fine. Now coming to this, let us see what types of industries do exist. Before that, we'll have some discussion about certain points. Please focus. See, company analysis. Company analysis is the analysis of an individual company, and it requires understanding a company's industry to which it belongs and identifying its peers. Peer is nothing but its competitors. So an industry is a group. So you understood what is peers, right? So if you want to study about a company, you also have to understand about the industry to which it belongs and also its competitors who give a stiff competition to that company. Okay. Maybe competitors can be better than the company which you like. Okay. Because everyone has a liking towards a company. I have a very good liking for Maruti Suzuki and I always buy Maruti Suzuki cars. Likewise, you may have your own liking. So now coming to industry, as I said, group of companies which are dealing with similar kind of products come under this, okay, or services like banks, banking. If you want to invest in banking stock, there are a lot of banks which give you the similar kind of services altogether. Okay, you won't find any unique services a bank is giving. They may have different names, but for their services, but the services are almost the same. What is their principal business activity? So is a source from which a company derives a majority of its revenues or earnings. See, I will tell you a small example. If you take China into consideration, so I will put a name on in front of you on the screen. And you are aware of this company. It is a Chinese company, which is a Chinese smartphone giant. But do you know they are also into electric car manufacturing? Yes, Huawei also have certain cars, electric cars, which they are selling in China, and they are one of the very good companies with futuristic technologies, as the information I have got from lot of newspapers and different, you know, sources. Okay, the sources which are available in the media. And hence you have also heard about Samsung. Samsung, we know, only sells mobile phones in India and also consumer durable goods like washing machines, refrigerator, etc. But you should know Samsung also sells cars in South Korea. It is also one of the car manufacturers in South Korea. But the principal business what Samsung has is, you know, appliances. With they started with appliances, then they again went into phones and also into cars, and they are also into aviation. That you should know. Okay, so that is the principal business activity from where they get their majority of revenues, and peer group is their competitors. Now, uses of industry analysis. Why you want to do industry analysis? Why? You want to understand a company's business and its environment. Environment is nothing but what surrounds a company. What factors are like, you know, are there around the company, or what kind of, you know, where is the company placed and what kind of environment you see around it. Then if why are you understanding a company's business and its environment? Because you want to select the stock, you want to select or pick a company whose stock you want to buy. And also you want to do credit analysis, because if you want to buy the bonds of a company, if you want to lend your money to a company and you want to enjoy the interest income, you have to do the credit analysis of that company. Why? Because you want to check the credit worthiness of that company. Then identifying active equity investment opportunities. Of course, being an investor, you always look for good opportunities, right? So you want to, you want to be an active investor, and then you want a selection of the security in which you want to invest, and also the industry in which you are interested to. So if COVID-19 was a time, I would like to go, I would have gone for pharma sector. It was doing very good those days, but not into hospitality. Then portfolio performance attribution. See, portfolio is nothing but not putting your money into only one stock. Instead of putting your money in one stock, you want to put your money into different stocks, so that your loss, your risk of any losses is minimized, because you have invested into a diversified, you have invested your money in a diversified portfolio, and you have reduced the risk of losses. So portfolio performance attribution. Attribution is what? Quality. So performance attribution, you want to check how it performs or your portfolio performs, and also the industry and sector which you have selected is performing. Okay. Now, approaches to identifying similar companies. So how will you identify two companies like which are like, you know, of which are offering similar kind of products, or which are similar companies? So you have to check the products with which they deal. So products or services what they give. Similar products and services are they giving? Industry and sector classification to the industry to which they belong, and a company's principal business activity. So Samsung and Huawei, I discussed their principal activities to sell appliance mobile phones, as far as we take the Indian market. Business cycle sensitivities. See, cycle is what? The point from where you start and the point at where you end. So cyclical companies are nothing but they start from a point and they have to come and they have to, stop at a point. Again, they have to restart, or again, they have to, make some modifications or changes to their product. And again, that cycle will run. So cyclical companies have profits correlated with the overall economy. Of course, if the economy does well, the cyclical companies earn good profits. Like if you see India, there are many companies which are, which are related to the macro factor, that is Indian economy. If India's economy is doing well, the companies would do well. I will take the example of clothing, luxury goods, etc. They are very much dependent on Indian economy. If the Indian economy is booming, people will buy those products. Okay. More of the companies which are dealing with wants, not with needs. Needs, however, you will fulfill whether the economy is doing well or not. But wants are something which only would work out, or you would only purchase if the economy is doing well, right? So mobile phones, now you will be having a question in your mind. Why mobile phones? Mobile phone have become a need these days, right? Yes, but not the high end mobile phones. See, maximum population in India is not buying Apple's iPhone. Why? Because it's very costly. Okay. Excuse me. Excuse me. Yeah, so cyclical companies, I have already explained you that if the economy does well, they do their business booms like luxury goods, luxury phones, high-end products, high-tech products, etc. And they are very much dependent on the economy. See, if economy is booming, that means businesses are doing well. The sentiment is positive in the market. People are very much positive about the market in like as a whole. Okay, so in that case, what is going to happen in that case? Like, people buy more and more luxury goods. They don't mind spending money. Before COVID-19, that was the case in India. Now, non-cyclical are utilities companies like, water, electricity. Okay, it doesn't matter how the companies, FMCG goods, food and beverages. It doesn't matter how the economy is performing, but they would always be in trend. They don't depend upon the economy. Okay, so business cycle sensitivities is nothing but how sensitive is the business cycle with respect to certain macroeconomic factors is what we are looking at. And then statistical similarities, groups based on correlations of security returns. Like, there are certain companies which you pick up. Okay, and there is a strong relationship between the products with which they are dealing. Telecommunication. Okay, I would like to take the example of certain sectors which are very much correlated. I would take the like any good example we can take. If the petrol prices are stable, the petrol cars are sold more. Okay, so certain groups are based on correlations of security returns. There is a strong relationship between the products what they sell. Okay, and based on historical returns, but relationship may not continue in the future. Yes, sometimes historical returns give a good picture about a company's future performance, but always that's not the case. May associate firms based on chance or may exclude important relationships. Now, these are the sectors in which you see a lot of companies, basic materials and processing. I would say the example here would be the mining industries. You extract iron ore to make steel. So that is the basic material, and when processed becomes a finished good like steel. Okay. Or some raw material like you take tomatoes and you convert that into ketchup. Financial services, banking. or NBFCs. Consumer discretionary. What do you mean by consumer discretionary? Any clue? Anyone? Yes. I'm asking what is the example of consumer discretionary? No one is answering. See, consumer discretionary is nothing but there are certain products which you want, but you don't need them. Okay. Example, durable goods, entertainment, leisure activities. You want to go for a holiday trip. This is your want, but this is not your need. Okay. So when you are good with your finance, when you are doing well, when you are earning good money, then you would go for all those trips. You will try to fulfill your wants. Okay. So consumer discretionary is nothing but it is upon the consumer, consumers, performance, like their earning capacity, etc. So I would rather give the example for consumer discretionary as durable goods, high-end apparels, luxury goods, entertainment, leisure activities, cars, fast foods, etc. Consumer staples are the FMCG products, the food and beverage, which is always important. Energy is electric, like I can say like NTPC power plant, Adani Energy or Tata Power. Consumer staples are like a lot of companies are there, mobile phone companies, automobile companies, or tourism companies. Healthcare, the Dr. Reddy Labs or any like company which is dealing with Apollo Pharmacy, Apollo, etc. Apollo Group. Industrial producibles, the durables are goods which are no longer time and they are used for converting raw material to finished goods. Technology, they develop certain technologies, R&D of Android software. They made it for the companies. Then companies are using that software, and Google themselves provide services like browsing services. It's almost a search engine. So there are technology companies, telecommunications like Jio and Airtel, utilities, water, sewerage, telecom, electricity and gas, and like the the GHMC, which kind of gives you all the services, like drinking water supply, etc. comes under utilities. So these are the companies which we discussed. Classification schemes, commercial industry classification schemes. So CICS, commercial industry classification schemes. Give me a second, I'll just connect to the chargers. So we are discussing about commercial industry classification schemes. So commercial industry classification schemes produced by private enterprises such as analysis firms and financial services firms. Okay, so commercial industry classification schemes, if you want to classify the commercial industries which are existing for profit making, okay, so how will you do that? You will take like produced by private enterprises companies, and such as you will do the analysis of firms, okay, and also financial services firms and governmental industry classification schemes produced by government agencies. So who will do this commercial industry classification? Some private companies will do, or financial services firms will do this. Okay, so classification of commercial industry is done by private enterprises and financial services firms, and government industry classification is done by government agencies, and the goal is to facilitate comparisons over time and across companies. Industry classification schemes, global industry classification standard GICS, they do this. The developed by Standard and Poor. So this is one of the financial services firm. Standard and Poor is a rating agency, and MSCI. So what they do, they classify companies for developing and developed countries. They will see what are the companies which are operating in developed nations and developing nations. Based on business activity, classifies each company into a sector, industry group, industry, and sub industry. So this is the way they do the classification. Okay. So the GICS, Global Industry Classification Standards, they have the task of doing the classification, and they have been developed by S&P and MSCI, and like they classify companies for different kind of countries. In that, again, the categories are developing and developed nations, and they will classify companies based upon their business activity, like extractive industry, mining industry. We have seen all the sectors, right? And classifies each company into a sector we have seen right now, or a industry group, like auto, heavy motor vehicle, light motor vehicle, under automobile, that is sub industry and industry. Russell Global Sectors, RGS, they classify companies by products and services. System has sectors, subsectors, and industry. Industry classification benchmark developed by Dow Jones and FTSE classifies companies by source of revenues, from where they generate their revenues, and also system has super sectors, subsectors, and industries. So they have different ways of classification. You have to understand this. Governmental industry classification schemes, industrial standard, industrial classification of all economic activities, ISIC. So these are governmental industry classification schemes. These are all government bodies which do the classification. So international standard industrial classification of all economic activities, ISIC, this is one of the government industry classification scheme. And statistical classification of economic activities in European community, they do for the European Union. This ANZ SIC does for Australia and New Zealand, and North American industry classification system does for North America. This does for the entire world. Now, identifying peer groups. So peer groups are what? Companies which are competitors and they are in a particular group. Okay. So examine classification systems for them. Review subject and company's annual report. You have to see which company you are picking up, and you have to study their annual report, and you have to take the competitors of that company and you have to review their annual reports as well. And then you should draw a comparison between the company which you are picking and its competitor. Confirm comparability and with potential peers. Now, describing and analyzing an industry. Analysts examine statistical relationships between an industry and business and economic variables. So what does analyst do? They do some examination. They check the statistical relationships between an industry and the business which belong to an industry, and also business in the sense company I'm saying. Okay. And economic variables. What do you mean by variables? Certain things are not stable. They change over the period of time. So we can take macroeconomic like, variables, GDP, GNP. So you want to check how a company is performing under in a particular economy, and how the variables can be anything, macro factors, micro factors, they vary, and how they have an impact on a particular business and industry. Analysts develop forecasts, often developing scenario analysis. What is scenario analysis? They put the company in different scenarios and check how the company is performing and behaving in that particular scenario. I'll give you a good example. Let's take a company which is running its affairs, or which is into production, and suddenly there is a strike in the company and the recession is going on. Consumers are cancelling their orders due to non-production of goods. So recession is going on, production is not happening, strike is going on. The demands of the laborers are such that a company finds it difficult to fulfill, and suddenly there is a COVID-19 lockdown also. So all together in such a scenario, how will you come out? That is what they do. Analysts may examine strategic groups, which are companies that share similar business models or specific market segments. Okay. And analysts often classify an industry based on industry life cycle. So what is the life cycle of a particular industry? Every industry will not have the lifetime sustainability. There are many industries which have lost their businesses in the previous past. Okay. Many industries are not existing as well. Many of the mechanical based industries in today's world are not there. Robots are taking up. Manual need is slowly and steadily going away. The drivers whom we are seeing right now giving like who are driving the cars, those are driver cars, but driverless cars are coming in the future. So there are many previously there were some industries which were manufacturing certain products which are not existing in today's world. Just a second. Okay, so analysts may examine strategic groups. Strategic groups are nothing but certain top companies which are a part of industry, and they are into similar products. They deal with similar products, and analysts often classify industry based on its stage in the industry life cycle. I told you right now there are many industries which have become extinct, like typewriters. Nowadays we don't see. The old ones which are there, they are just used. Xerox machines. These days very less, more of prints are happening because PDFs, e-copies are coming. The cameras, the olden days camera and the reels are not there right now. Digital camera has come, etc. The experience curve is a representation of how the direct cost per unit of a good or service produced or delivered declines as a function of cumulative output. Yes, as you go on producing more and more output, okay, the cost per unit decreases, of course. Framework for industry analysis. So intensity of competition. Of course, the competition has become very intense these days. You see, for every businesses, there are certain factors which have a bigger impact on them. And one of the bigger factors is threat of new entrants entering into the market. Okay. So intensity has increased. Demographic influences. Yes, population plays a very bigger role. India is a market whereby the population is very high, henceforth many businesses do well in India, but the same thing is not applicable for the like businesses which you see outside India. They struggle. Okay, you see a few handful big companies doing good in those countries, but you see in India there are a lot of grocery stores. Apart from The bigger players like DMart and Reliance Retail and all, the grocery stores also do well because of the demography we have. We have a big population. Okay, so uh, like these stores are not enough to fulfill the needs always. Macroeconomic influences like GDP, GNP, etc. have a bigger role to play. Government influences, yes, government has a bigger role to play. If the government changes and the policies are against the citizens, if the policies are not favoring businesses, not citizens, here we are speaking about companies, not favoring companies. The favors here, I mean to say, like very strong regulation, not always liked by companies, then that will have a problem. Technological influences, suddenly the technologies are changing now. Okay, the AI is taking up many things. So now outdated technology is not of use for us, and social influences. Then see strategic analysis of an industry. So if you want to make a strategy regarding a particular industry, okay, or an investment strategy, if you want to invest in a particular industry, you have to check 5 things, and Potter 5 forces will help you to do that. These are the Potter's 5 forces. Threat of entry, yes, threat of new entrants entering into the market, that they have a very big threat to us. Yes, as we see in some areas, some of the in our area we have a sweet shop which moved here 2 years back, and they had a very good business. I am not name the store. They had a very good business, and in some Diwali season they earned 3 crore rupees revenue. That shows they had a first mover advantage. But after that, 5 more stores have come up in our area, and suddenly the business has, I won't say declined, but the market share has been, the market share gets distributed. Now they are also having the chunk of the market, and many customers are, they are driving the customers towards them. So the same thing is not there for the sweet shop which opened like firstly. Now they are facing competition. Then threat of substitutes. Close substitutes can kill your business. What can be the example of substitutes, if you can tell me? See, ink pens and ball pens, ballpoint pens. What happened to ink pens? How many of you are using ink pens these days? A handful, or very rare. It should be kept in the museum. The fountain pen which used to come, the Chinese fountain pen, right? I don't even remember the company's name now. I think Gold Pen, something it used to come, was very famous, very famous company those days. Hero pens, I think, I don't remember. What happened? The ballpoint pens them. So threat of substitutes is again a problem. iPod has killed the Walkman business. Rivalry among existing competitors, that has to be seen. So you need to check whether the substitutes are there or not. If substitutes are not there, then that's a good sign for the company in which you want to invest. Then bargaining power of suppliers, whether suppliers are supplying the raw material at higher prices. If that's the case, then you have to see. And the power of buyers, whether the company is dominating or the customers are dominating. It's a buyer's market. See, now real estate, what is happening? It's a buyer's market. But down the line, before COVID or before, the previous government it was a seller's market. Seller is to sell at whatever price they want. And rivalry among existing competitors. These are the 5 forces. Now, factors affecting pricing power and price competition. We are only speaking about the price competition. Barriers to entry are obstacles or hurdles that limit or restrict the entry of new competitors in the market. These barriers keep or discourage new entrants, hence reducing competition. Yes. So we are speaking about price competition and pricing power. So barriers to entry, that means entry is not given that easily. So restriction of entry for the new companies to enter into the market will discourage the entrants at times, and that will reduce the competition. Not good for the customers, good for the companies. Industry concentration is a degree to which some companies may dominate the industry in terms of market share. Generally, the more concentrated an industry, the less competitive it is. Yes. That means more industry, more concentrated industry, nothing but only few firms are having the bigger access to market. Industry capacity is the maximum amount of good or service that can be supplied in a given time period. The more limited the capacity, the greater the company's pricing power. because they produce less, supply is less, the prices will be more. And market share stability is the degree to which market shares change over time. The more stable the market shares, the less competitive the industry. That means more stable. If you have a larger share of the market and more stable, the industry is less competitive because you hold a bigger chunk of the market. Industry life cycle, everyone knows. First, it is in the embryonic stage, development stage. Then here the embryonic stage comes to an end. That means the product has been developed. Now it has to come into the market and should be, should be coming for public display. And then it starts growing. Then shake out. That means it reaches to some point whereby it's growing again. It comes to the maximum maturity stage. Again, people find that product to be more outdated now. They don't want that product because they are fed up, and again it starts declining. It goes to the decline stage. Again the cycle has to start again from embryonic stage. Applying the life cycle concept. What is life cycle? The product from when it is made to the time period when it comes to an end, its expiry. So using the life cycle model, newer industries tend to be more competitive than mature industries. Yes, because they are newer ones, right? They have a desire to grow. They have come with an ambition, but one day people will be fed up. That day should not be 20-30 years, because that entrepreneur will make good amount of money till that time. And growth companies tend to reinvest in new products and services, and mature companies tend to focus on internal efficiencies. Of course, mature companies are generally more focused on extending successful product lines. Everyone knows mature companies are ones which have come to the topmost level, and they want to do some modifications, and they want to make more precision based product. Like the product what they are giving is the best one. They want to just add some features extra and then want to make some improvements and give to the people. And limitations of life cycle model is changes may disrupt the cycle. Some technological change comes, some regulatory change comes, some social changes, some demographic shifts. You see the changes in the model, and not all companies in industry have the same performance. Characteristics of industries here: major companies are very big companies. Barriers to entry: yes, they don't allow other companies to enter that easily. They have the lot of concentration of market, and they have a bigger impact of industry, the capacity, because maximum capacity is with them. And the industry stability is there. Their product starts from a point, and life cycle we have seen right now. Price competition is seen, like like in case of the industry's products. And then demographic influences, population plays a bigger role, we said. Government regulations play a bigger role. Social influence, what society thinks about the product and the company. Technological factors, and growth versus defensive versus cyclical factors. External influences on industry growth, profitability, and risk. What are the external influences? Macroeconomic influences like level of production, interest rates, availability of credit, and inflation. See, if you are going to invest in a company, don't you want to look at the macroeconomic factors or influences? Yes. At what level the company is producing? How are the interest rates in the market? Whether the interest rates are less, and the government is encouraging the industry to take more loans and creating demand, or interest rates are very high, that will lead to future products being very costly. Cost push inflation can be seen, and inflation is a very big factor to be considered, because you would always like to desire more returns in an inflated economy. And also availability of credit is important factor. If everyone is not ready to invest in equity, then what will happen? The companies have to depend on debt, whether it is easily available or not. Technological influences include new products that change how companies do business. Yes, technological factors. If new technologies are not introduced and you always go with the old outdated ones, then what happens? You're not going with the change. You have to adapt to the changes. Otherwise, you will be you will not be able to push your product in the market. Like Kodak, the Kodak, the famous company which had the camera and the reels and all, and they were the pioneers in the world. They ruled the world for 30-40 years in case of photography and camera. But what happened? Digital cameras came and they killed their business. Finished. So they did not go for this digital camera thing. They said that no, we are going with our own thing. Nokia was always going with their own software, Symbian or some software they were using that they did not develop. Seeing the future, Android came and killed their business. Finished. Samsung accepted Android's offer, and rest is the history today. Demographic influences include distribution of consumers by age and gender. Governmental influences include taxes and regulations have to be considered very important. More taxes, less creates less demand, less taxes, more demand, more good for the companies to flourish, and more less taxes, more savings, more investments can be done. Social influences include how people work and spend. That is also a very important factor. If India is an economy whereby people spend, then companies would come here and invest. Okay. Then elements of company analysis, you have to check the company's profile, the industry to which it belongs, what is the demand of its products and services in the market, supply of products and services, whether raw materials are promptly supplied to them, and also they supply on time. Company's pricing environment, whether it has an intense competition of competitors or how, and ratio analysis can help you in a very bigger way to understand the company's overall performance in all the areas like liquidity, short-term liquidity, solvency, like turnover, profitability, overall profitability, etc. And then now we come to the summary of this chapter. We are going to end this. So company analysis and industry analysis are closely interrelated. See, already the chapter what we have discussed right now, we have discussed everything right now. So summary is what is nothing but what we have discussed. The same thing is here. We have discussed everything in detail. So no need to discuss the summary. In fact, I would like you to go through the chapter thoroughly and understand everything from your text, and then be ready for the test in the coming 1 or 2 days. Okay. So all the things are clearly mentioned and all the things are clearly explained. If you have any kind of doubts, please come to my, bring to my notice. We'll discuss that one. Okay. Thank you all of you.
Thank you, Gayan.
Thank you. Thank you, sir. Thank you, sir. Thank you. Thank you. Really,